Look at this market, just ridiculous, busted through this resistance like it was no problem. 200-day moving average, who cares? But of course, the question you always got to ask yourself, which is why we ask ourselves this pretty much every week, is this bull market for real? Should we be worried about how fast it's gone up, just non-stop? And is there potential for it to turn around? Well, that's why we're making this video, to go into the data and figure it out. And of course, we got our research firm Macro Ops to help us. Our latest research starts with a quote from Robert L. Bacon. Yum. He said the beginner plunges ahead on a favorite that loses, then bets lightly on a fair price horse that wins. He keeps switching amounts and positions so that he never has a worthwhile bet on a winner at a worthwhile price. He's always one race behind the form of a horse and several races behind the rhythm of the results sequences. Now, Robert here is using the example of horse betting, but honestly, this could be applied to anything, especially the stock market. Because we all know one of the toughest things to do in investing is figure out how much you should invest into each one of your stocks. And that whole process is the process of position sizing, which is something that pros struggle with all the time. No one has a perfect answer, because we know what he's talking about here, right? When you end up putting too little money into one stock that takes off, and then the one that you put too much money in, that's the one that drops. And then at the end of the day, you're looking at your P&L and you're down, even though you picked a really good winner. Because how much profit you make from that winner, a lot of it depends on how much you're betting on it. So it's a really key aspect of investing that a lot of people ignore, and even when you're not ignoring it, it's still kind of tough to figure out. And actually, that's one of the things we go over in our free training because it's such an important part of your strategy. So in this training, we go over how I invest and the strategy that I use, which includes, of course, position sizing. If you want to check that out, there's a link in this video and a link down below in the description and comments. It's free, it's useful, so check it out. So in this crazy bull market, last week we saw something that hasn't happened in 29 years. 96% of the S&P 500 stocks were above their 50-day moving average. And the reason we track something like this is as a breadth indicator. So you want to see what the total market is doing. And a ridiculous amount of stocks are above their 50-day average, which is very bullish. And that's after hitting near record lows in March with that whole CCPV crash. Now, the last time we hit these levels was in early 1991, which was following the 90-91 bear market and recession. And after we hit it, we got that huge 90s bull market that went into the tech bubble. Now, this is only one data point, but it goes back to that theory that I had, where instead of seeing a second crash, maybe we get a massive bull market. Because what do you usually need at the top of a stock market? You need a lot of froth, a lot of high sentiment, people loving it, just piling everything into stocks. And we never really saw that with the last crash. But then with that crash, all of a sudden everyone started piling all the money that they were holding into the market, and this is why we got this huge run. And this is also why retail players are making so much money. So for there to be froth, for people to really pile into the market, they need to see other people making money, and this is a perfect time to see that. So what if we go hit new highs and then just keep ripping? Then we see the second mortgages and the leverage and all this money getting thrown into the market. And finally, when the last bear gives up, that's when we'll get the massive crash. The most spectacular crash we've ever seen. It's just a theory, but every day that this market keeps going higher, the probability of that happening grows. That's actually what I hope happens, because again, I'm always looking for the funniest outcome in the market, because no one could have predicted after all this crazy stuff happening, the market takes off to new highs and we get a massive bull market. No, nobody was predicting that, especially with the market that we've had since 2009. Crazy. So this chart from NDR shows all the times where we've seen this breadth indicator cross above that 90%. So more than 90% of stocks being above their 50-day moving average. And out of the 19 cases where this happened, the market was up a year later each and every time, with a median return of over 16%. So again, this is a very bullish sign what we're seeing now. And this isn't just happening in the US either, it's happening in global markets. So here's the same NDR chart, but for the European index, where 92% of stocks crossed over their 50-day moving average. And that happened for the first time in over 3 years. Bullish. And then we can look at the dark index, which is a measure of off-exchange transactions. They hit 52.3% Friday, and that's the highest number ever on record. So off-exchange transactions have been overwhelmingly bullish since late March. And this is my favorite part, where everyone's super confused. The strong demand for risk assets that we're seeing is making many financial Twitter warriors and newsletter writers headspin, because they see a total disconnect between the market and the economy. But what they don't understand is that the market operates off its own fundamentals. It's not directly attached to the economy. And recently, the market saw a huge boost to the demand side of that equation. What does that mean? It means a ton of people are flooding into the market to buy stocks. So the major brokerages, like we talked about before, Robinhood, Charles Schwab, TD Ameritrade, E-Trade, they saw new accounts grow as much as 170% during the first quarter. So really, one of the biggest beneficiaries of the stimulus checks was securities trading. Everyone's piling it into the market. So you can see right here which groups of people and what income earning levels put that money from the stimulus checks straight into the market. Now, that's good to see that a lot of people people decided to save it. But you see this third category right here between 35 and 50,000. The third thing they were doing with their money, straight into the market. Same with the next level up, 50 to 75. And for some reason, this doesn't have anybody making between 75 and 100 putting into the market, but 100 to 150, they're putting all of it into the market. And above 150, it's actually their last category. And this data just continues to support all the stories that I've been hearing from financial advisors and, even on YouTube. I see it in the comments. People are excited. So people email Alex all the time, who's our lead researcher in macro ops. And they ask him, are you bullish or bearish right now? Because, what is going on in this market and economy? And he really doesn't have a single answer for that question because it depends on the time frame. And even then, his opinions are very weakly held, especially now. He's just trying to play the tape in front of him and let the market tell him what's what. And I think that's something that we got to talk about because I've been seeing a lot of comments saying, hey, AK, I didn't invest in this market because you kept calling for a second market crash. And yes, we were looking at the data and there was a probability of the second crash coming. But even so, myself and all our fallible members who use this strategy that I talk about in this training, we've been long this whole time since that March bottom. And the reason why is because our strategy told us to get long the market. So all this research that we go over every week, it's really important how you use it, which is why your strategy is the most important thing, because your strategy is going to tell you what data points to use, what research to include, and more importantly, what to not include, because there is so much data, so many data points, so many opinions out there. So like Alex said right here, he's playing the tape right now and letting the market tell him what's what, which is strange, right? Because we're a global macro research firm. Why would we be depending so much on price action? We got all this data, we could do all this fancy research. Well, when it comes to either using price or all our fancy research, we're always going to go with price. Price is king. And that's not just a sentiment that we share, it's also what a guy like Paul Tudor Jones, a legendary billionaire market wizard, he does the same thing. He said at the end of the day, he'll throw out all his research if price is going a different way. So again, in my strategy and the one I talk about in that training, price is the biggest factor. In fact, it's the only factor. So it's great to know what's happening in the economy and how that affects us. But at the end of the day, I'm going to go with actually what the stock market is doing, because the stock market and the economy, they're not equal. And I got to go with supply and demand and the emotions that are driving prices. And how you do it and how you use the research depends on your strategy. So if you're a fundamental guy, then no, you're not going to be dependent on price. You are going to use your analysis of the economy and make a decision based off that. Is that better or worse? I can't really say, because it's really dependent on how you want to invest. For me, that would be terrible. And another thing that factors into this is how big are you? So a pension fund that has billions and billions of dollars, they're not going to be able to move just completely off price. These guys, who are some of our clients at macro ops, they take our research to make long-term decisions because they can't hop in and out with all that money. They're more allocators. So hey, if the stock market looks shaky, let's move some of our money into bonds. Now for you and me who are smaller, we're able to jump in and out. There's enough volume in this market to support that. Even at PTJ's level, who's managing billions, he's able to do that too at a certain extent. So it's only the huge institutions that get trapped, like really need to use the fundamentals to make these long-term decisions. But if you're smaller, use that as an advantage, be more nimble. You don't have to buy and hold because you're trapped by your size. I just got an email the other day from a new fallible member who was saying, hey, AK, I just jumped out of the market on this long trend upward because I'm a bear at heart and I thought things were going to turn around, but I'm glad I'm using your strategy now because that'll prevent that from happening. And I completely understood what she was saying because I'm the same way. I tend to be more conservative and bearish, but the reason I have my strategy in place is so it can operate without my biases interfering. So let me give you an example with Zoom right here. Now our strategy from that training told us to enter Zoom on June 1st. And check it out, we're entering Zoom after it's already had a massive run. So me being conservative and bearish, I didn't really want to enter Zoom. I mean, look how much it ran up already. Is it really going to run up more? That was my bias. But fortunately, my strategy said get in so I could, ignore my bias, and I got in. And within a few days, as you can see here, it jumped over 20%. So literally the day after I got in, I was already taking some profits off. So if I listened to my bias, I wouldn't have made that trade. And my biases run deep with Zoom. I hate Zoom so much because as soon as this CCPV thing happened and we were all quarantined, all of a sudden people that you haven't spoken to in years are hitting you up saying, hey, AK, you want to Zoom? It's like, why would you want to Zoom now after all these years? We didn't have anything to talk about back then. You think we're going to have something to talk about now? And what's wrong with texting? What, we can't text anymore? Because that way, at least if the conversation is boring, which I know it will be, I could just wait a week to respond, thereby just completely killing the conversation so that it doesn't have to go on, just saving us both the trouble. But how am I supposed to do that on Zoom? We're looking right at each other. Am I just supposed to stare at you blankly and just not respond to anything you're saying until you just forget that we were having a conversation and turn the thing off? I wouldn't mind doing that. And then then people have the audacity to get mad at me for not turning on my video. Why would I want to turn on my video? Like, what are you trying to see? I look just as scruffy as you do. We aren't about to get freaky on this call, are we? Because if we are, then sure, I'll turn on my video, but otherwise, I'm gonna keep my video off. That way I could roll my eyes as much as I want as you tell me about your job that you know I don't actually care about, or you rant about how bored you are in quarantine, as if I'm not bored myself, as if you're not making both of us bored with this conversation. Also, with no video, I'm free to browse the internet, pick my nose, really do whatever I want. Anything so I don't have to listen to you, and that is freedom. Freedom from you. And that's just how I feel about Zoom calls. So obviously I didn't want to get into the stock to support this nonsense. But if you look at the TSI reading of Zoom, it's #1, even above Tesla, everyone's favorite. So what's a guy to do? You just got to get in. And if you're wondering what the TSI is, we cover it in this training right here. Another thing I wasn't happy about when investing in Zoom is the fact that they have their servers in China. And if a server is in China, that means it's a CCP server where they could see everything. And there are Chinese developers that work on the company, and they got in trouble for all this security stuff as they were blowing up. So is it a CCP stock? Kind of, maybe. And we talked about this, like, why should we be investing in Chinese stocks and supporting that? I actually support that law that should be coming where they're going to ban all of them. That would be great. Capitalism can be wonderful when it has some rules and guardrails in place, and that's the job of the government. So this is a good example, like a personal example for you and me, what these bigger companies feel, because there's all this competition to go into China and make those profits the same way we might be feeling the pull to invest in a Chinese stock, because again, competition, you want to miss out on those gains. So it's much easier when the government puts rules in place and just takes those pieces out of the game. And then alternatives rise, American alternatives. So you could tell me how you feel about it down in the comments. But moving on, one more thing about the CCPV is determining what the impact of the virus is. So one obvious thing is that it's going to increase the global death rate, but less obvious is that it's going to increase the global birth rate, which is important because ever since R. Kelly went to jail, people haven't had the music they need to procreate. And this is from Ensemble Capital, and they said historically baby booms occur for a combination of cultural and biologically programmed reasons. In the aftermath of a tragic experience such as a pandemic, it's natural for people to reconsider their goals, priorities, and changing circumstances. One of the important things that comes out of an event like this, where people are stuck at home dealing with potentially grave illness, is the realization of the importance of family, companionship, or simply boredom avoidance. Because if you're bored, then the best option is to stick your people doing something, because that's how animals forever have cured their boredom. That's why we're all alive. Boredom avoidance. So that, combined with the ability to move further away from urban areas and increasing affordability in the suburbs, because the remote work trend is not going away. Cities are about to become real different when not everyone has to work there, especially if those are the most dangerous places where you could get sick. Well, all those things together may cause baby booms around the world. In the US, that might stabilize or reverse the trends of lower than replacement procreation. Again, the R. Kelly in jail effect, where in 2019 we only saw a 1.7 fertility rate, below the 2.1 needed to sustain a population without immigration. You can see right here on the chart of birth rates, we had that huge boom with the baby boomers. That's why they're called baby boomers. And we actually did hit a new high with Gen Z. But then, everyone started realizing what they did, creating these little annoying, flossing, TikToking Zoomers, and they put it back in their pants. So the birth rate started dropping again. But now I'm excited for this next generation because they're going to be born in the time of Corona, where they'll be trained to just stay indoors and shut the hell up. Very excited to not see them and have them not annoy me. And as you can tell, I'm going to make a fantastic old man. In fact, I'm already there. I just need all these damn kids off my virtual lawn. Maybe I just belong in quarantine, I just won't come out. But here's one thing, with all this bullishness, there was a development that does look a little bearish. And that development is a stretched put to call ratio, because it indicates that there's a lot of complacency and some short-term fragility in the market. So you can see right here, the put to call ratio is reaching lows, meaning there's a lot more calls being bought, which are bullish, over puts. And pretty soon it might reach 0.5, which is the exact February peak before we saw that big crash. So this is something to monitor, in case there is a downturn coming in equities. And one last thing I got to show you is this little comic right here. The fundamentals of the economy are good, but I'm not earning enough to survive. Oh, that isn't one of the fundamentals. Working yourself to death is optimum. It's funny, I was just talking about this with the team where this Federal Reserve manipulation of the stock market. We were talking about how it has created wealth disparity before, well, after this, the gap is just going to widen so much more. People with money making more money, and people without money, without even anything to invest in the stock market, getting screwed because the real economy is doing terrible. But this fake market economy, yeah, everyone's getting rich. You're just sowing the seeds of more problems in the future. We're going to see it come back and bite us in the ass later. But while things are good, you might as well have a good strategy to benefit while you can. So again, this free training will teach you the strategy that myself and a lot of our Fallible members use. There's a link in this video and down below in the description and comments. And if you like this video, make sure you hit that like button, or don't hit it. I actually don't care. Just subscribe so you can see the next one. And what I would like you to do is comment down below, because I love comments. So subscribe, and I will see you in the next video. Stay fallible out there. Bye.